Hey everybody, this is Kevin, a CPA that does financial planning, and today I wanted to talk about the old saying of selling in May and going away. And it's truly market timing. I have some real heavy duty analytical statistical data. I have something from the Wall Street Journal, nice color pictures, and then I have something from Rick Ferri from Forbes who went through some data, and I think his data is the most impressive. But the thing I wanted to first say is that, any type of strategy, market timing strategy, buy and hold, anything like that. I mean, past performance truly is no guarantee of future results, and that's part of the problem is that human beings are always looking for a better way to invest. And so when we hear these kind of things, such as the January effect, which I discussed in a prior video, such as election year returns might be good or bad, such as sell in May and go away might be a strategy. I don't advocate any of these strategies at all. The issue I find, though, is that when markets start to go south, let's say that today someone tells you, hey, I'm going to sell in May and go away, and then you see them again in June and markets are down, you're going to wish that you did it, and then maybe you'll even sell in June because this person will convince you that the summer months are so bad. So I at least want to give you the evidence, but more importantly than even the evidence is to ask the question, what does this data have anything to do with your retirement, your goals? So the first piece I'm going to show you is from Ronnie Shaw, Sell in May, Go Away, Market Timing and Stock Return Seasonality. And so he took a look at some data, and the first piece of data was from the CRSP. This was Kenneth French's data, the CRSP CRISP, they call it 1 through 10, and this is all U.S. based data. And so what he found is that if we look back to 1926 to October 2010, this was written in 2012, that yes, there's certain months that appear to have higher return. Now, is this statistical evidence or is this noise? He goes on to say that he thinks this is just statistical noise. But 1.48 in January, the worst month was negative 0.72%. If you do a rolling 6 months back, 6-month time period, what they found is all 6-month time periods were positive. Not to say that the market's always positive, but when they looked at the data, rolling 6-month time periods were all positive. And so this whole idea of April being the most positive is the reason why the idea of sell in May and go away came about. And this data is saying sell for 6 months. So that would be from May 1st to October 31st. Okay, let me pause it and go to the next. So this is from Nobel Prize winner Robert Shiller, who's pretty famous. Out of sample evidence, and this was looking at non-U.S. returns from 1871 to October of 1926. 1926, that's right. And so this was not in the same time period, this was before. And what they found is that sell in February, because January was the best here, the last 6 months, if you would have sold in February and gone away, it appears you would have had higher returns in that time period. So again, we have data that conflicts. Therefore, let's go to some more simple ideas. And the reason why everybody thought sell in May and go away made perfect sense was the story behind it, the narrative. We love narratives and we love patterns. Was that people in May would leave and go on vacation, and the wealthy investors would all go to the Hamptons and go to the beach. It was a beautiful story. The problem is the data just doesn't seem to back it up. The evidence doesn't. So I'll talk about this last. This is Rick Ferri and some data that was produced. So this was something really simple that the Wall Street Journal did, and this is a different time period. Sell in May and go away. The S&P 500 performance between Memorial Day and Labor Day. Okay, that's the true definition of summer. What they found is that in all summers, Again, it doesn't mean every year it's going to be up or down the market. I'm not making that claim. But all summers averaged, there was a 1% return by investing in equities. Okay, summers when the stock rose, there was an average change of 5.6%. And that was 30 years. So 30 of the years, if you would have been invested in stocks, you would have had a 5.6% average return. And the summers when stocks fell, it was a bit bigger. There were 15 of them, and it was an 8% change. So again, looking at this data, one could argue that, hey, let's sell in May, or let's sell actually on Memorial Day, and then let's buy back on Labor Day. But you still would have had a worse performance by doing this of about 1% per year. So the best article I have found is from Rick Ferri. And Rick wrote in Forbes. And he talks about the CXO Advisory Group in Virginia. And the firm, once again, used Robert Shiller's data, I believe. Let me confirm that. They did use Robert Shiller's data, 1871 to 2011, and they looked at 3 different groups of data. The buy and hold, okay? Buy and hold is dead constantly. Anytime the markets go down, people say buy and hold is dead. So let's look at what buy and hold did over this 142-year time period. Hold stocks from May to October, and then hold treasuries the remaining 6 months. So we're actually going to do the opposite of sell in May. We're going to buy in May. And then the third one is truly sell in May and go away and hold U.S. Treasuries for the remaining 6 months. And so here comes the chart. It's very, very small. Let me try to blow this up a bit. Okay. Oops. So what we see here is the buy and hold portfolio, and this is a logarithmic chart. So $1 in 1871 becomes over $100,000. The people that sold in May and went away did have a bit higher return. That's the right here. Just got something, an advertisement just jumped on top of my photo. But anyway. So the sell in May and go away did have a bit higher return. If you actually sold in or bought in May and then went away in November, that was a little bit less of a return. But once again, as always, what we see is that buy and hold is not a good way to invest. It just seems to beat everything else, at least historically. I can't say that it will in the future, but once again, the data does not support the idea of selling every May. I mean, what if I came to you and I said, my strategy is for you to hold stocks for 6 months, sell, and then buy them back again? What day would we sell and buy? Would there be taxable implications? Heck yeah. Would there be trading costs, friction? Heck yeah. And so it's just not a good strategy. But here is the final thing I'd like to tell you, is that if you are an investor and you're investing for 10, 15, 20 years, why would you think about what's the price this year? I mean, why is that so important to us? I know we like short-term performance, but why does that really matter if May through November 1st the stock market goes down a few percent or goes up a few percent? It doesn't matter to our long-term goals. What we care about is the positive returns that we get with risk capital over long periods of time. Most of this data is just the U.S., but if we can put U.S. and world data together, I can tell you that people in Europe and the Far East are not going to the Hamptons over the summer. So if we own all these different asset classes, large, medium, and small, we own bonds, stocks, REITs, I think things are going to probably come out best. I can't say that there's proof of that, but there's a lot of evidence to support that. So thanks so much for watching. I'm Kevin, a CPA that does financial planning. Again, thanks.